All right, let's talk about what just happened in the crypto market because it was one of the wildest days we've seen all year. Prices just fell off a cliff, stop losses got absolutely vaporized, and then, just when everybody thought it was over, the market staged this comeback so violent it left everyone, bulls and bears, completely stunned. We're going to break down what this all means.
So, this is the big question on everyone's mind, right? Was that insane price swing a real sign that the bulls are back in control, just clearing out the weak hands before the next huge leg up? Or was it something more sinister, like a final deceptive bounce before we see a much deeper correction? We've been digging through what the experts are saying, and we're going to lay out both sides of the argument for you.
First off, let's just take a second to appreciate the sheer chaos of this move. I mean, in just a few hours, Bitcoin was plummeting towards that critical $1,120,000 level, and Ethereum, it dipped below $4,200. It was a sea of red everywhere. But then, almost in the blink of an eye, both of them just reversed with incredible force, wiping out all the day's losses and then some. I mean, it was a picture-perfect, V-shaped recovery. Now, this kind of whiplash price action, it feels like it's designed to cause the most pain possible. First, that huge plunge wiped out all the leveraged longs. Then, the explosive recovery turned right around and liquidated anyone who tried to short that breakdown. So it was this move that basically shook out both the bulls and the bears, and it left pretty much everyone scratching their heads.
So what on earth caused this? Was it just random market craziness? Well, according to a few of the analysts we follow, this wasn't chaos at all. They're arguing it was a very calculated maneuver, something traders call a stop hunt or a liquidity grab. Let's get into what that actually is.
Okay, so here's the core idea. The big players in the market, they have a pretty good idea of where a ton of smaller retail traders are placing their stop-loss orders. A liquidity grab is when they intentionally push the price down to that exact level. This triggers a massive flood of automatic sell orders. And what do? They step in and absorb all of that selling at a discount, basically cleaning the market of weak hands before they drive the price right back up. It's almost like a forced market reset.
Let's walk through exactly how it works. First, the price gets pushed below a well-known support level, in this case around $112,000 for Bitcoin. Second, this sets off all those stop-loss orders from people who were betting the price would go up. Third, the big players, they just buy up all those sell orders on the cheap. And finally, with all the sellers now flushed out of the market, there's no downward pressure left, and the price just rockets back up. Analysts like TIABTC and Funga were actually calling for this exact sequence, saying it was a necessary move to clear out all the stop orders just sitting below the recent trading range.
So you might be wondering, how can a giant crash like that actually be a good thing? Well, from the bullish point of view, this liquidity grab wasn't just a shakeout. It was an incredibly positive signal about the underlying health of the market. It basically showed that under all that surface-level panic, there was a massive wall of buying pressure just waiting at those key levels.
Analyst Miyalashi points to a few really key takeaways here. The fact that those critical support levels held up is huge. This specific pattern, a sharp breakdown followed immediately by a reclaim, that is a classic textbook bullish reversal signal. We also saw this huge surge in buying volume on the way back up, and the short-term momentum indicators on the 4-hour chart, things like the MACD and RSI, have now flipped decisively bullish. All of this is bringing a lot of confidence back into the market.
So where do the bulls think we're headed from here? Well, a bunch of analysts now believe this whole move has cleared the path for Bitcoin to go back and re-challenge its major resistance. And a number of them, including TIABTC and Miyalashi, are now pointing to $120,000 as a very probable next target if this momentum keeps up.
But, as always, there's another side to the story. So let's pivot and look at the more cautious, more bearish perspective. Some analysts are putting up a red flag, warning that, the rebound was impressive, but it might be hiding some really serious weakness in the market's underlying structure.
And this quote from analyst btrend.arn really sums up the whole bearish argument perfectly. The idea here is that the market just isn't ready for a new, sustainable run-up. It hasn't spent enough time building a solid foundation. You see, a healthy trend needs these periods of sideways action, of consolidation, and this crazy V-shaped recovery might just be a short-term reaction, not the start of something that can actually last.
And a key piece of evidence for this view is what they're calling deceleration. If you look at Ethereum, for instance, analyst Bchandaran points out that the most recent rally to its all-time high was actually weaker. It was less aggressive than the rallies before it. And on top of that, the pullback that followed was way deeper.
This combination of weaker upward momentum and a harsher correction is a classic sign that a trend is running out of steam.
For Bitcoin, the bearish argument is maybe even clearer. Analyst Funga points out that even though the price bounced back hard, that initial plunge actually broke a really critical structural low on the daily chart. From a technical point of view, that break may have just confirmed a double top, which is a major bearish reversal pattern. So in this view, the bounce we're seeing right now isn't a recovery. It's just a relief rally back up into what is now a new level of resistance.
And applying that same logic to Ethereum, this means that the all-time high of around $4,800 is no longer the launch pad for the next bull run. Instead, the cautious analysts see it as a hard ceiling, the top of a long-term consolidation range. And they're arguing that until the market goes through a much longer period of sideways chop, any attempt to break that high is probably just going to fail.
So what we have here are two completely opposite stories. A bullish shakeout designed to refuel the rocket, and a bearish structural break that signals more pain ahead. So how do we figure out who's right? Well, it's all going to come down to how the price behaves at a few very specific, very critical levels that all the experts are now watching like a hawk.
Okay, this is basically your cheat sheet for the next few days. For Bitcoin, the bulls absolutely need to defend support between $112,000 and $115,500. The real test, though, is whether they can smash through resistance between $118,500 and $120,000. If the price gets rejected there hard, that gives control right back to the bears. And for Ethereum, the battleground of pretty much that whole range between $4,200 and $4,800. For the bulls to prove their case, they need to see a decisive, high-volume break above that all-time high. Anything less is a win for the bears.
And that brings us right back to our big question. Was this a masterclass shakeout that just refueled the bull run for new highs? Or was it simply the last gasp, the final bit of hope before a much deeper correction takes hold? The bulls see a classic liquidity grab. The bears see a structural break in weak momentum. The answer is going to be written in the charts at those key levels we just went over. All we can do now is watch.